Welcome to Talk Tickers. We're doing a deep dive today into Dominion Energy, ticker D.
Yeah, focusing on their Q3 2025 results.
Yeah.
They dropped midday, October 31st. A lot to unpack.
Definitely. A lot of anticipation around this one. Key things were what? The Coastal Virginia Offshore Wind Project, CVOW.
Right, is it on track? That's a huge one. And then there's this massive load growth story. Data centers, mainly.
So our mission here is to cut through the noise, really check that execution on CVOW, and figure out what this growth means long term.
Exactly. Let's get into it.
Okay, so financials first, because honestly, the numbers looked, well, pretty good.
You really did. A solid beat. Operating EPS came in at $1.06 SE share.
And $1.06. And, you had to put that in context, right? There were some moving parts.
Absolutely. So it did get a 3-cent boost from those RNG 45Z credits, renewable natural gas.
Okay, from the IRA.
Yep. But here's the kicker. It also absorbed a 6-cent hit from weather. Worse than normal weather.
6 cents. So they overcame that drag and still hit $1.06.
Exactly. Which made it a pretty substantial beat versus consensus. That was 93 cents. So with Dirtle was 13 cents better. 13
cents clear. That's strong. And the top line, revenue.
Revenue also beat expectations. Came in at $4.53 billion. The street was looking for like $4.19 billion.
Wow. So that's what, 15% year-over-year growth?
Yep, 15% shows some real underlying strength, beyond just weather noise.
Okay, so strong results. How did that translate into guidance for the full year?
Well, they tightened up the range for 2025. It's now $3.33 to $3.48 per share.
But the midpoint stayed the same.
Exactly, still $3.40. And crucially, management sounded quite confident.
How so?
They explicitly said they expect to deliver results at or above that $3.40 midpoint. Now, that assumes normal weather for the rest of the year.
Right, always that weather caveat.
Always. But still, it signals confidence. Clean beat, confident outlook.
And there's always a but in the market, isn't there?
Yeah. The market's reaction was, well, muted. The stock actually closed down over 1% on high volume, too.
Okay, so good news from the company, but the stock drops. What does that tell you?
It screams sector pressure. Or, maybe technical factors. Something bigger than Dominion's specific results was driving the tape that day.
Interesting. We'll come back to why it might have dropped. But first, let's dig into those financial anchors management kept hitting on.
Right. The foundation.
Oh.
First off, they absolutely reaffirmed the long-term growth target, that 5 to 7% operating EPS CAGR.
That's the core regulated utility story, right? Steady compound.
That's the whole thesis. And they need capital to do it, big capital.
So how are they managing that? Any updates on financing?
Yes, some helpful news there. They basically said the 2025 financing plan is largely complete. That includes using their ATM equity facility.
The at-the-market equity program. So dribbling out shares slowly.
Exactly. It means less near-term pressure, less risk of a big disruptive equity offering right now. Kind of de-risks the immediate funding needs.
And they kept talking about the balance sheet, that FFO to debt target.
Mm-hmm. The 15% FFO to debt, funds from operations. It's their signal to the credit agencies.
Saying, hey, we can handle this debt load even with big projects.
Precisely. It provides a cushion, shows commitment to keeping their ratings solid, even while they're spending billions.
Speaking of billions, that big capital plan, 2025 to 2029, still around $50 billion.
Still around $50 billion, yeah. They confirmed a full update is coming with the Q4 results, so early next year.
Did they hint at the pace of spending within that $50 billion?
A little bit. They sort of signal that any incremental capital beyond what's already baked in might be pushed towards the back end of that 5-year plan.
So managing the near-term impact on bills, maybe? Customer affordability?
That seems to be the driver. Balancing the huge investment needs with keeping things manageable for customers in the short run.
Okay, let's pivot to the biggest single chunk of that capital plan right now. CVOW, Coastal Virginia Offshore Wind. Where does that stand?
Physically, it's making real progress. They said it's about 2/3 complete now, so 66%.
2/3. What are the key milestones hit?
Well, the really foundational stuff is done. All the monopiles are installed, 100%. All the export cables are laid, 100%.
Okay, so foundations and connections are in place.
Right, and they just installed the second big offshore substation jacket. The last one is due in Q1 next year.
And when do we actually see power flowing?
Target is still late Q1 2026 for first power, full completion by the end of 2026.
And they mentioned something about how the revenue comes online, not all at once.
Yeah, they use the term de-chunkified, which basically means as they commission strings of turbines throughout 2026, the revenue starts flowing incrementally.
Ah, okay. So a smoother ramp up, not just flipping a switch at the end of 26.
Exactly. Better for earnings visibility, too.
Makes sense. What about the budget? Any changes there?
The total projected cost is now pegged at $11.2 billion. That does include about $443 million in tariffs.
11.2 billion. That's a huge number. How much is left to spend?
About $3.0 billion remaining. But crucially, Dominion's share of that is only about half, $1.5 billion.
Because their partner, Stonepeak, is funding the other half.
Correct. Stonepeak has that 50% non-controlling interest. That partnership really helps Dominion manage the cash outlay. Big de-risking factor.
Okay. Sounds mostly positive on CVOW progress, but there was one big headache they talked about quite a bit, the installation vessel.
Ah, yes. The Charybdis. This is the main operational challenge right now. It's the special Jones Act compliant vessel needed to install the turbines.
And the problem is?
It arrived back in September, but it came with issues. A punch list of about 200 quality assurance items that need fixing before it can start work safely.
200 items, that sounds like a lot.
It is. They said they've worked through about 120 of them. But the delay in getting it fully operational is eating into their schedule contingency.
So potential delays to the overall project timeline.
Potentially. Management acknowledged it could push a, quote, small number of the final turbine installations just into early 2027 instead of late 2026.
Okay, a small number. But they downplayed the financial impact, said it was de minimis.
They did. And financially, because of that de-chunkified revenue ramp, delaying a few turbines at the very end probably doesn't move the needle much on 2026 or 2027 earnings.
But what about optically? Reputational risk, a delay on a flagship project like this.
That's the real issue, isn't it? It's about execution credibility. They need to show they can manage these massive, complex projects. Any slip-up gets magnified.
Did they say why the vessel had these issues? Is it related to, like, government stuff or politics?
No, they were very clear on that. This is purely operational. Getting the vessel itself ready, nothing to do with permits or policy. They expect it to be resolved and start installation this month in November.
Okay, so a key thing to watch in the near term. That vessel needs to start working.
Absolutely. It's the biggest question mark right now.
All right, let's shift gears from that specific project risk to the almost opposite story.
Yeah.
The certainty of massive load growth, the data center demand.
Yeah, it's hard to overstate this. The numbers are just accelerating. The total pipeline of potential data center demand.
So everyone asking for power.
Right, the total requests they're seeing. That's grown 17% just since December last year. It went from 40 gigawatts to 47 gigawatts now.
47 gigawatts. That's an astonishing number, equivalent to multiple large cities.
It's huge industrial scale demand. But, the pipeline is one thing. What really matters is the committed load.
The ones who've signed on the dotted line.
Yeah, exactly. Those electric service agreements, the ESAs, that committed load is now getting close to 10 gigawatts.
10 gigawatts locked in.
Locked in. These are customers committed to taking that power, usually ramping up over the next, say, 4 to 7 years. That 10 GW is the bedrock for their capital spending for the next decade, essentially.
And all that demand is forcing them to update their big generation plan, the IRP.
It is. The integrated resource plan reflects this. It's really an all-of-the-above strategy. They need everything.
Like what? What's in the plan?
New solar, obviously. Big utility-scale batteries for storage. They just filed for $2.9 billion worth of storage projects in October.
$2.9 billion just for storage.
Yeah. And also new natural gas. That Chesterfield Energy Reliability Center, that's a 1 gigawatt gas plant, basically designed for reliability when renewables aren't available.
Okay, so solar, storage, gas.
Yeah.
What about nuclear? Especially with that kind of base load demand growth.
Well, that was probably the most significant strategic decision in the update. They decided to delay pursuing new small modular reactors, SMRs, by 5 years.
Push nuclear out. Why? Given the need for carbon-free power?
Management was pretty blunt about it. Concerns over cost, basically. First-of-a-kind technology risk, the potential for huge cost overruns, and just the overall impact that kind of uncertainty could have on their business risk profile.
So caution won out over speed on nuclear for now.
Seems like it. They're prioritizing less risky, more proven technologies in the near term, even if SMRs could be a great long-term solution.
But they are leaning into the transmission needed to support all this growth, right?
Oh, absolutely. Can't deliver the power without the wires. They submitted a big batch of project proposals to PJM, the grid operator.
PJM, right. the regional transmission organization.
Yeah. They said it was their largest proposed investment in transmission since PJM started this competitive open window process.
Building on previous wins.
Yep, they got nearly $3 billion in projects awarded last year. They expect to hear back on these new proposals in Q1 2026. It shows they're actively trying to build the infrastructure needed for that 47 GW pipeline.
Okay, so let's try to tie this together. We've got a clean financial beat, reaffirmed long-term growth. CVOW is mostly on track despite the vessel issue.
Partner funding helping there.
Right. And then this absolutely explosive, committed data center load growth nearing 10 GW.
Yeah.
Yet the stock dropped on the day. Why the disconnect? It seems like more good news than bad.
It does seem that way on the surface. The execution message was strong. The growth story is undeniable.
So what else could be dragging it down?
It really points back to those macro factors we mentioned. Rate sensitivity is the big one for utilities.
Because they're often seen as bond proxies. So when rates go up, utility stocks tend to go down.
That's the classic relationship. And with rate volatility or fears of higher rates, big institutional investors might just sell the whole sector, regardless of individual company performance. It becomes about asset allocation flows.
So Dominion might have just gotten caught in that broader utility sector downdraft.
That's the most likely explanation for the one-day move, yeah. Management's job now is to just keep executing, hit their numbers, deliver on CVOW, build out for the data centers.
And hope the market eventually rewards that 5-7% compounding.
That's the plan. Prove the credibility through execution and let the regulated earnings growth speak for itself over time.
Okay, which brings us inevitably to our favorite segment. This is absolutely positively not financial advice.
Definitely not. We are talk tickers, and we sometimes pitch, let's say, thought-provoking trade ideas based on the disconnects we see.
And the disconnect here seems pretty clear, right? Market hyper-focused on the Charybdis risk.
Yep, that short-term CVOW execution anxiety.
While maybe underappreciating the sheer scale and certainty of that 10 GOW committed data center load.
Exactly. The short-term noise versus the long-term structural demand.
Yeah.
So the idea is to play that divergence.
Okay, lay it on us. What's the outrageous but plausible trade?
It's a volatility play, essentially. Using options to express a view on both time horizons. Two parts.
Part one.
Part one. Sell short-dated, out-of-the-money puts, maybe expiring just after the Q4 earnings call early next year.
So betting the stock doesn't crash further, betting that the Charybdis issue gets resolved smoothly, or at least isn't a disaster by Q4.
Precisely. You collect premium by betting against near-term panic or a significant downside surprise. If the stock hangs in there, those puts expire worthless.
Okay, collecting premium short-term, what's part two?
Part two. Use that premium you collected from selling the puts to help finance buying long-dated call options, maybe out to 2027 expiration.
So using the near-term bet to fund a long-term bullish view.
Exactly. You're betting that once the near-term CVOW noise clears, the market will start to price in that massive regulated capital deployment for data centers and the resulting 5-7% EPS growth compounds.
So selling near-term fear to buy long-term growth potential.
That's the essence of it. A spread trade across time horizons, funded by the market's current fixation on operational risk. Again, not financial advice. Just an idea.
A provocative one, as always. Okay, so let's wrap this up. What are the key takeaways for you, the listener?
Well, first, the Q3 beat was solid, operationally strong, even with weather headwinds. Second, the balance sheet focus is real. They're committed to that 15% FFO to debt target to maintain credit quality.
And the whole story really boils down to execution, doesn't it?
It does. Efficient deployment of huge amounts of regulated capital. First, on CVOW, getting that finished despite the vessel hiccup. And second, building out the grid for that incredible wave of data center demand.
Which leads to that final provocative thought you wanted to leave folks with related to the SMR decision.
Yeah. Thinking about that 5-year delay on new nuclear. Given how fast data center load is growing, 47 GW pipeline, and given Virginia is generally pro-nuclear.
How long can they really afford to wait? Is 5 years too long if this demand keeps accelerating?
That's the question. And maybe more importantly, what would it take to pull that timeline forward? Would they need some kind of government backstop? Maybe risk sharing on potential cost overruns or guaranteed returns to make taking that SMR plunge less risky for shareholders.
Interesting. So the next big strategic decision might be revisiting that nuclear timeline if the demand picture gets even more extreme.
Could be. Balancing massive growth needs with prudent financial risk. That's the tightrope they're walking.
A fascinating balancing act indeed. Well, thanks for joining us for this deep dive into Dominion's Q3. Lots to track here.
Definitely. Keep an eye on that vessel and those data center contracts. Thanks for listening.